Hello, good morning, sir. Am I audible?
Yes.
Hi, sir.
Hello.
Good morning, everyone. Someone please confirm in the chat box whether I'm audible or not. Hello, good morning, sir. Am I audible?
Yes, you are audible.
So warm welcome, Vinay, Shraff, sir, and
One.
to all of you. Welcome to the third session of our National Tax Lecture webinar series. Over to you, sir. We can start now.
Yeah, let us wait for 2 minutes more. I mean, more participants will join. Usually start at 11:05 or so. So let us wait for another 2 minutes.
Yeah, sure, sir.
Okay, let us start. Very warm welcome to all of you and very good morning. So the today's topic is discussion about the today's discussion is about the issues surrounding the dispute relating to the valuation issues, which I perceive which may arise in the time to come. So, as been my endeavor, I will try to discuss the jurisprudence which is already available for us in the erstwhile era of central excise, service tax, and VAT, and the various disputes which arose and how the various tribunals, high courts, and Supreme Court resolved those issues, and the interpretation which has been adopted. So those are the things I will try to discuss. So let me just share the PPT for today's discussion. Is that PPT visible now? Okay. So first and foremost, the very elementary concept of valuation or the necessity of the valuation provision, there is a Supreme Court judgment in the case of CIT versus BC Srinivas Shetty, it's a very celebrated Supreme Court judgment. And it was held that in order to levy a tax, two things is necessary. One is there should be a charging section and there should be a computation provision. And these two constitute a integrated code, and any transaction which needs to be taxed, the computation, and if the computation provision cannot be applied, then it can be presumed that it was never intended to be taxed, and therefore it is a necessity to have a valuation provision for all types of transaction and all circumstances, so that tax can be charged and levied. So we have Section 15 of the Central Goods and Services Tax Act and the State Goods and Services Tax Act. And relevant rules are from Rule 27 to 35, which contains provisions relating to the computation of the taxable value. So the purpose of the valuation provision is to compute the taxable value of a transaction. We know that the GST is an indirect tax. So in order to levy a tax, it must be possible or necessary to compute the taxable value of a transaction. And in order to arrive at the taxable value of a transaction, we have Section 15. And in case Section 15, by application of Section 15, we are unable to determine the taxable value of a transaction, then only Rule 27 to 35 comes into the play. So if we are able to satisfy the conditions as has been laid down in Section 15, then there is no need to take recourse to the rules for the purpose of computation of the taxable value. So what does Section 15 say? Primarily, it says that it is the transaction value, that is the price paid or actually payable, is what is relevant to determine the taxable value, provided the supplier and recipient are not related and price is the sole consideration of such supply. So there are two conditions. One is that the buyer and seller are not related. That is, the supplier and recipient is the terminology used here. They are not related. And price is the sole condition. So if those two conditions are satisfied, then it is the transaction value, that is the price actually paid or payable, which will be levied to tax. Now this price, it may be less than the actual cost price. The concerned supplier may be selling it at a loss, but that will go out of consideration, provided price is the sole consideration and buyer and seller are not related. So in most of the cases, this invoice value, which is adopted for the purpose of a transaction, there is no difficulty in determination of the taxable value. Having said that, there are some inclusions and exclusions which are provided in Section 15 itself. So before we finally arrive at the taxable value, we need to look into what has to be included and what has to be excluded. So it says that any taxes, fees, charges levied under any law other than the GST law will be included. Then secondly, expenses incurred by the recipient on behalf of the supplier. So if anything which the buyer is incurring with respect to the transaction which was supposed to be incurred by the seller, and it is actually incurred by the buyer, then that will also be included. For example, as per the terms of the contract, suppose if the freight is supposed to be paid by the supplier, the transportation and insurance also is the responsibility of the supplier. But for convenience, the transporter is engaged by the buyer and the freight is also paid by the buyer. So in that scenario, even though the freight charges are paid by the buyer, they will be included in the cost of the supply. Similarly, if suppose insurance or suppose some packing which is necessary for the purpose of supplying, the cost is incurred by the buyer. Some additional packing in order to ensure that the product or the item does not break down during the transportation, it is incurred by the buyer. So any expenses which is supposed to be incurred by the supplier in order to ensure that the goods are supplied safely in the hand of the buyer, and it is in fact incurred by the by the supplier, but in fact incurred by the buyer, then such expense will be included within the value, taxable value of the supply. Further, any incidental expenses like commission and packing incurred by the supplier. So suppose the supplier is making payment of some sales commission or any other commission for the purpose of ensuring the sale of the goods, and it is recovered from the buyer. It is necessary that it must be recovered. If the expenses, suppose say some commission agent is appointed and that commission agent commission paid is not recovered from the supplier, then it will not be required to be added to the taxable value. But if it is recovered from the buyer, then it will be added. Similarly, if the packing charges, interest or late fees or penalty for delayed payment will also be included. And further, if any subsidy, except the government subsidy, is given by a third party, then that will also be included in the price. So there can be a scenario whereby you see there is a delayed payment, and as per agreed terms of the contract, suppose the interest of say 18% is recovered, then that interest will be added to the price to arrive at the taxable value. Now, one question which arises in my mind is that suppose there is no contractual liability to pay interest or late fees, but suppose an entity is an MSME, and such MSME is there is a delay in payment to an MSME supplier, and as per MSME Act, some interest is liable to be paid. Then the question arises whether such a interest, which is not a contractual interest, but it is an interest mandated by the law, whether such an interest will form part of the taxable value. I would like the view of the participants, because there is no jurisprudence as of now available on this particular issue, that if the interest is paid, which is not a contractual interest, but interest is paid in accordance with the law, that is the MSME Act, then what happens? Whether it will form part of the taxable value or not. Participants, can you give your view on this particular issue? Yes, Bhavna is saying it should not form part. Mr. Baid is saying, Rajesh Baid is saying it will not form part. Mr. Manmohan Modi is saying it should not form part. Devesh Karkaraj is saying it should not form part. Ramesh Misra ji also said so. Susanto Kumar Saha says that does the statutory act has an overriding effect on the contract? Okoba says no. No, Mr. Chandrasekharan is saying financial interest will not form part of the GST taxable value. No, it is not about the financial interest. It is about that it is an interest for delayed payment. Now, Mr. Purushottam Gopal is saying it is post-sale, no excise duty on such interest. Rajbir Singh is saying it will form part of taxable value. So we have opinion on the both the sides. Majority, I would say, the opinion is that it should not form part. But there are participants who believes that it should be included in the taxable value. Let us have a look at the provision. It says the value of supply shall include interest or late fee or penalty for delayed payment of any consideration for any supplies. So if we look at the plain reading of the provision, I think Mr. R.K. Khurana, I will go by his view. He has said that the excluding part of the section 15 does not make any distinction between interest, whether it is paid under law or as per agreement. Therefore, it should form part of the consideration or taxable value. I totally agree with Mr. Khurana, because you see, we in the taxation laws, what is the literal interpretation will prevail over any other interpretation. So on a plain reading, section 15 subsection 2 clause D says that the value of supply shall include interest or late fee or penalty for delayed payment of any consideration for any supply. So it does not talk about whether the interest is or delayed payment or late fees or penalty is payable in terms of the contract or whether it is payable in terms of the MSME. So in my view, it is immaterial whether it is paid as per contract or whether it is paid as per the contractual value. Now, secondly, now there are exclusions also. Now I will go to the other aspects also one by one. I will discuss all aspects of inclusions and exclusions. Now, one more thing which I asked: what happens if suppose tax, fee or charges levied under any law is the liability of the buyer? It is not the liability of the seller, but it is liability of the buyer. But suppose for some reason it is the seller who pays such tax for convenience, and recovers it from the buyer, then what happens? Then what do you think what should happen? On this also, there are some judgment in the erstwhile regime. To what extent they are applicable, I'm not very sure. So we will have a jurisprudence which will evolve over a period of time. So I give you an example of such a transaction, which I believe can happen. Suppose there is a high C sales. High C sales means the goods are bought by the buyer on the high seas. That is, before they enter the territorial jurisdiction of customs frontier of India, the ownership of the goods is transferred to the buyer. Now, if such a ownership is transferred to the buyer before the goods are imported in India, then obviously customs duty, whatever is payable, is responsibility of the buyer. Further, any other expense, say clearing and forwarding charges, or suppose any fees or port charges incurred at the time of importing, they are also the responsibility of the buyer. Now, what happens to that? What do you think? Whether if the buyer is responsible for payment of the customs duty, then whether just because it is charged by the supplier, whether it should form part of the taxable value or not. Again, I invite views of the participant on this particular issue. Participants, I want your active participation on each and every issue which we are discussing. It will make the discussion interesting, and not only that, since the jurisprudence in the GST Act is still evolving, and there are a lot of things which wherein you see our common sense or our logic is going to help in evolution of the jurisprudence. So we need to keep our thinking caps on and think on our feet. Mr. Chandrasekhar is saying that it is the liability of the buyer, so should not form part of the taxable value. Kusum RH is saying it will not form part of the transaction value. Shivang Khandelwal is saying it has to be added in the taxable value as its buyer liability to pay seller is only facilitating the same. Should form part of the taxable value. It will not form part of the taxable value. Mr. R.K. Khurana is saying if the liability for the expenses is that of the buyer recipient and the supplier incurs those expenses only as a pure agent and seeks reimbursement of those expenses as expenses will not form part of the taxable value. Very correct, Mr. Surana. Again, I thank you for very pertinent reply and very elaborate and detailed reply. So I agree with Mr. R.K. Khurana that it will not form part of the taxable value. The reason being that the concept of pure agent may come into play, or rather will come into play, but whether irrespective of the concept of the pure agent, my view is that the law says that the value of supply shall include any taxes, duties, cesses, fee and charges levied under any law for the time being in force, if charged separately by the supplier. So, if we go by the bare reading of subsection 2, then it appears that if it has been charged separately, then since it is not mentioned in the provision as to whose liability or responsibility it is, it should be immaterial. But if we go to subsection 1, it says that the value of a supply of goods or services or both, which is price actually paid or payable for the said supply of the goods. So it should be a price, it should have a relationship or link with the price of the value of the goods. If the goods are already sold and the price is recovered subsequent to the any charges or reimbursement is subsequent to the transaction of sale itself, then in my view, it cannot be said that it has any link with the supply whatsoever. The transaction of supply is already complete on the high seas. So the event of payment of custom duty is subsequent to that event, and it has got no relationship whatsoever with the sale of that particular goods or supply of that particular goods. And since that link is not there, therefore, in my view, this particular customs duty, which has been incurred by the buyer, which is the liability of the buyer, but incurred by the supplier, will not form part of the taxable value. Now, further, there are exclusions from the definition of supply. For example, there is a trade discount, quantity discount. So if any discount, which is the normal trade practice, and pre-supply discounts, they are obviously recorded in the invoice and they will be excluded while determining the taxable value. So as far as any discount which is given with before the supply, there is no difficulty. But if the discount is given after the supply, then it is necessary that two conditions should be met. One, that the discount is established in terms of pre-supply agreement between the supplier and the recipient, and such discount is linked to relevant invoices. So it should not be ad hoc discount, it should be invoice-wise discount. If any ad hoc discount is given, then or a special discount is given, then such a discount will not be deducted. Secondly, input tax credit attributable to such discount is reversed by the recipient. Now, what happens to a situation where the input tax credit is not admissible to the recipient, or suppose the input tax credit is not availed at all because the recipient is a consumer. So if the recipient is the consumer, then the condition of input tax credit becomes irrelevant. Further, if the input tax credit is not available or not admissible because it is covered by, say, section 17(5), then also this condition becomes irrelevant. But the primary condition that the discount should be should be in terms of a pre-supply agreement between the supplier and the recipient, and such discount should be linked to invoices. So these are the two necessary conditions which are very, very important to claim it as a deduction from the taxable value. Now, uh, uh, with respect to the primary condition that price is the sole consideration of sale, there is a very interesting judgment of the Honorable Supreme Court in the context of the Central Excise. In this particular case, what happened was that the manufacturer of the car, in order to penetrate the market, Indian market, and compete with the other manufacturer, was consistently selling their cars below cost. And it was going on for a very long period of time, for more than, say, 5 years. So the question arose, and obviously those buyers were not related. They were customers or the dealers of the Fiat India. So the question arose that whether keeping such price artificially depressed for a more long period of time, whether it can be said that the price is the sole consideration, or whether it can be said that the objective to penetrate the market itself is to be treated as a consideration. And therefore, the valuation rule has to be adopted for the purpose of determination of the taxable value. Now, as I said at the inception of my talk, that there are two conditions which are necessary to avoid recourse to the valuation rule. One is that the price should be the sole consideration, and secondly, the buyer and seller should not be related. So here the question arose that the buyer and seller are obviously not related. But what about the price being consistently kept below market price, below cost? Whether in such a situation, it can be said that the intention to penetrate market itself is a consideration, and therefore the valuation rule has to be adopted. It was a dispute in the context of the Central Excise law. So it was held by the Honorable Supreme Court that extra commercial consideration in fixing of the price and artificially depressing the price gives rise to a conclusion that price was not the sole consideration for sale. It was held that the no prudent businessman can be expected to continuously suffer losses only to penetrate market. They are expected to act with the discretion to seek reasonable income, preserve capital, and in general avoid speculative investment. So therefore, it is immaterial that there was no allegation that the buyer and seller was related, and therefore the valuation rule should be adopted to determine the price. It was said that the consideration means something which is of value in the eyes of law. It may consist either of some right, interest, profit, or benefit accruing to one party, or some forbearance, detriment, loss, or responsibility given, suffered, or undertaken by the other. Therefore, when the word consideration is qualified by the word sole, it makes it stronger so as to make it sufficient and valuable having regard to the fact, circumstance, and necessity of the case. So therefore, in this particular case, So I think this particular judgment is going to be used by the department. Why I'm discussing this judgment, that you see, we see a lot of startups these days who consistently incurs loss in order to penetrate market. And it has become a fashion or a norm to burn the money for 2 years, 3 years. The startups usually are able to have access to the fund of the angel investor or private equity. So even the private limited companies, small startups, they are able to incur losses for 2, 3 year, 3 year, 4 year consistently, just to be able to enter to the market. And they hope that in some time to come, the venture will become profitable. And it has also in some cases been seen that the objective is not sometime to make profit at all. The objective is to acquire the sufficient number of, say, subscribers or customers, so that the subscriber or the customer itself become a valuable asset in itself, and they are able to sell or exit their their investment at a substantial profit and make good money out of their investment. Whether the company makes profit or not sometime become irrelevant, because it is looked into from the eyes of the investor, and the promoter or the investor many a times does make good money even though company incurs losses for continuously 2 year, 3 year, 4 year. They make an exit after making good amount of profit on their investment. So I think a question is going to arise whether the transaction value should be discarded in such a scenario, price not being sole consideration of sale, and the valuation method should be resorted to determine the price of the goods at which the GST should have been paid. We will go and discuss the valuation rule subsequently, but I leave it you with this thought that what will happen in these startups in the background of this particular Fiat India judgment. Now, another question which arises in my mind on the plain reading of the definition is that it says, the definition says, we have discussed the taxes duties part, that what happens, what sort of taxes duties should be included. Secondly, we have discussed the interest or late fees part. Another inclusive part, clause B, says any amount that the supplier is liable to pay in relation to such supply but which has been incurred by the recipient should be included. Now here the question arises in my mind is that whether free supply should form part of the taxable value or not. Now again, friends, I invite your participation and your views on this particular aspect, that if suppose in the discharge of any service or any supply of goods or any works contract, if some goods or services are supplied free by the buyer, then whether it will form part of the taxable value. Mr. T.K. Chandrasekhan says there is no consideration, so no, not to form part of the supply. Free supply is, Mr. Rajesh Bed says free supply is without consideration, it should not form part of the taxable value. Mr. Sumit Chakravarti says FOC should be part of taxable value. Janardhan Jyotirlingam says ITC to be reversed. Mr. Purushottam Gopal says under center excise valuation, the following cases excise duty is payable or not. It depends on the responsibility. Sanjeev Choksi said it depends on the responsibility of the parties. Bhavna says amount received by recipient should be part of the taxable value. Khusal Rajpal says barter is taxable under GST. Free supply also form part of the taxable value. But here the question is not of a barter. I am not bartering anything. I am talking about the free supply. Mr. R.K. Khurana says the cost of so-called free supply is already covered in what has been the main supply, therefore no reversal required. If it is covered, so here the question is not whether it is a reversal of ITC. I am talking about the inclusion in the taxable value. Mr. Ramesh Misra says if it is covered under warranty, then not part of the taxable value. Sanjay Mane says free supply should also form part of the taxable value. Okay. So now let us have a discussion of the two judgments of the Honorable Supreme Court, one in the context of the service tax, one in the context of the VAT. So Supreme Court in the case of CST Commissioner of Service Tax versus Vayana Builders, it was held that in the background of the argument, it was argued by the department that payment received in any form and any amount credited or debited as the case may be is to be included for the purpose of arising at the gross amount charged. And it should be liable to service tax. Now, in this backdrop, let us have a look at the definition of the consideration in the context of GST. What does it say? It says that consideration means any relation to supply of goods or services includes any payment made or to be made, whether in money or otherwise, in respect of, in response to, or for the inducement of supply of goods or services or both. So here also the definition is not identically worded, but almost the same. In the service tax said, it says that any payment received in any form and any amount credited or credited is to be included for the purpose of the arriving at the gross amount charged and should be levied to service tax. And in the service tax, in the GST, it says that any amount made or made, whether in money or otherwise, in respect of supply. So the question arises whether in this backdrop, the free supply should be included in the value of taxable supply of or not. So Honorable Supreme Court said that the gross amount charged by the service provider for such services would lead to conclusion that the value of goods material that is provided free of charge by the recipient should not be included in arriving at the gross amount, simply because the provider of the service is not charging it from the recipient. And in fact, in respect of the goods or services or material supplied by the recipient, no service is provided by the SAC or the service provider. So unless that is satisfied, gross amount charged cannot enable the department to ignore the contractual value or the amount actually charged by the service provider to service recipient for service rendered. So it was held that any amount debited or credited to any account would not include the value of free supply, as such free supply is not credited or debited in the books of accounts of the supplier. So on a reading of this judgment, it appears that the Honorable Supreme Court says that we cannot ignore the contractual value, and unless it is debited or credited in the books of accounts, we cannot say the money has been received by the supplier. The equivalent of the money equivalent of the goods supplied free by the recipient is in any way received by the supplier, and in fact no service is rendered with respect to such free supply, so therefore it will not be included. Now in the VAT era, there were a number of judgments where it said that we know that in many contracts, it so happens that a comprehensive contract is given to a contractor for say supply of various materials as well as say supply of services. But in some cases, in order to ensure the quality of the goods, or suppose there is no delay on account of any procurement issue at the end of the contractor, the material is supplied by the recipient and the value of such material is deducted from the contract price of the supplier. So if this be the case, then it can be said that the property in the goods has transferred from the recipient to the contractor, and it can be said to be a supply of the sale of the goods by the contractee to the contractor, and the price which is adjusted, sale tax will be payable. So on a reading of both these judgment, and also there is a circular in the context of GST which says that if there is a mold or dies which is owned by the original equipment manufacturer that are sent free of cost to a component manufacturer, the issue was clarified by virtue of a circular, and it was clarified that while calculating the value of supply by the component manufacturer, the value of molds and dies provided by the original equipment manufacturer to the component manufacturer shall not be added to the value of such supply, because cost of the mold dies was not incurred by the component manufacturer and does not merit inclusion in the value of supply. Further, it was said that if the contract was for the supply of components made by using the molds dies belonging to the component manufacturer, but the same had been supplied by the original equipment manufacturer to the component manufacturer, then the amortized cost of such molds and dies shall be added to the cost of the components. So on a combined reading of this circular and these two judgments, one in the context of the VAT era and another in the context of service tax era, my opinion is that if the contract is entered into such a manner that it is a composite contract for the supply of goods as well as services, and it is the responsibility of the supplier or the contractor to supply the material, but if it is supplied by the recipient, then it will be included in the value of the taxable supply. But suppose there is no contract between the supplier and the buyer, or the contract or the contractee, then it will not be included. So to give you an example, suppose a contract of 100 rupees is entered into and the value of 30 rupees of material is supplied by the recipient or the buyer. The supplier raises full invoice value of 100 rupees. The buyer pays him 70 rupees. 30 rupees is deducted toward the cost of the material supplied free of cost to the supplier or the contractor. Then in that case, the GST will have to be discharged on a 100 rupees value. But if the contract value is 70 rupees only, and the supply of material free of cost is responsibility of the buyer itself as per the terms of the contract, and it is not the responsibility of the contractor at all, then it will not form part of the taxable value, and such free of cost supply need not be included. Okay. So I now move on to the next issue. I hope this is clear to everyone. Now the next issue is incidental expenses, including commission, packing, charged by the supplier. So what sort of charges or the packing can be included in the taxable value? In one of the judgment of the Bombay High Court, it was held that the development charges like say design and tooling are included in the value as they are the necessary concomitant of the final sale price. So suppose some design and tool charges or some charges are incurred by the supplier and they are separately recovered from the buyer, then they should form part of the taxable value. Now, the another interesting question which arises in this context is that the GST law clearly says that the packing charged by the supplier has to be included in the taxable value. Now, here in this context, there are two questions which arises in my mind, and these questions arises because of the plethora of judgments in the context of central excise on these particular issues. And I believe that whether due to ignorance or whether due to planning, these disputes are going to arise in the context of GST era also. So two questions relating to packing are: secondary and primary packing. You see, there can be a packing which is necessary to sell the goods, and there can be a packing which is done at the request of the buyer. It may not be necessary, but the buyer says, look, I want my goods to be delivered in this particular manner, and you should take this extra precaution and pack. And apart from that primary packing in which you are selling me the product, please do this additional packing also. So whether such additional packing will be includable in the taxable value or not, this is question number one. Second question I will ask after I receive response from my friends on this particular issue. So what is your view? Whether the packing which is not necessary for the purpose of selling the product, whether it should form part of the taxable value or not? Yes, Mr. Asus is saying it should form part of the taxable value. Any other opinion? Mr. Chandrasekharan is saying once consideration paid for such extra service by the buyer. Once consideration paid for such extra service by the buyer, it is a taxable supply. Part of the taxable value, it is recovered separately. The cost of packing, whether primary or secondary, charged by the so form part of the taxable value. That is the opinion of Mr. R.K. Kurana. Then Mr. Kusal Raswar said that form part because it is a composite supply. Mahendra J says it should forming part of the value. Mr. Janardhan Jyoti Ramana. Mr. Ganesh says yes, form part of the taxable value. Tarun Agarwal says the criteria may not be decisive for the question before us. The consideration is paid, it will be taxable value. Manmohan will not form part, it is a precondition, but the view of we will include this cost. So let us look at how the Supreme Court and what the says, then I will give my opinion. The Supreme Court says that the packing whose cost to be included, it was a judgment in the context of central excise. So it says whether it is necessary to determine whether the packing is necessary for putting the excisable material in the condition in which it is generally sold. If it is, then the such cost is liable to be included in the value of the goods. And if it is not, then the cost of such packing has to be excluded. Further, even if the packing is necessary, the value will not be included if the packing is of durable nature and is returnable by the buyer to the SEC. So, Honorable Supreme Court says that you have to distinguish between the necessary and the packing which is not necessary to sell it. If it is a packing which is necessary to put it into the market, then it will be included. Otherwise, it is not. Now, in other subsequent judgment, Honorable Supreme Court said that while judging the necessity of the packing, one must see whether it is necessary. One must see the conduct of the manufacturer. And it further said that ordinarily speaking, no manufacturer would provide a packing which is not necessary for putting the excisable articles in the condition in which they are sold in wholesale factory at the factory gate, where a special kind of packing is provided by the manufacturer at the request of a buyer. The situation would be different, but that is not the situation here. Therefore, one can proceed on the footing that whatever packing is provided at the time of delivery of the goods at the gate is the packing necessary for purpose of putting the excisable condition in the condition. Unless the manufacturer establishes that a particular packing is provided, the value of packing cannot be excluded. So here, on the basis of two judgments, my view is that Section 15 says that incidental expenses. So incidental to what? Supply. So first of all, it should be incidental to the taxable event of supply. Only then it can be included. So packing has to be incidental to the taxable event of supply. Incidental means, according to me, it must be necessary for selling the product. If it is not necessary that at all, then in my opinion, it is not incidental to the taxable event of supply. And if it is not incidental, then it is delinked from section 1. Because whatever we have to include in subsection 2, it should have a live link to subsection 1. Unless that live link is there, in my opinion, anything which is incurred will not form part of the taxable supply. So there must be a live link to the taxable event. It should be incurred prior to the taxable event of sale. And only if that condition is satisfied, and if it is paid, price which is paid or payable in relation to such supply, and it is a link to the taxable event of supply, only then it should be included. So in my view, if any special packing at the request of the buyer is provided, which is not at all necessary for the purpose of sale, then it cannot be said that it is the need of the supplier, or it is for the purpose of the supply. It has got no link whatsoever to the taxable event of supply. And such a packing which is at the special request of the buyer, it is in fact an expense incurred at behest of the buyer, and therefore such a expenditure which is incurred at the behest of the buyer is not the liability of the supplier, and therefore it should not form part of the taxable value. Mr. Sivang Khandelwal is saying that packing charges will be termed as rendering of separate service, although not form part of the taxable supply. Yes, it can be a view which one can take, that the packing can be rendered to be a separate taxable event. But in this particular scenario, I believe that if it is supplied cost to cost, and if it is no service at all is provided by the no taxable event, no service at all, nothing is done by the supplier, only at the behest of the supplier a packing is done, then there is no taxable event which is happening from the supplier to the buyer. It is between the supplier of the packing material and the buyer. So when the supplier of the packing material is incurring supplying the packing item, then he must be charging the GST, and that is what should be charged, and there should not be further charge of the GST by the supplier. Now, Mr. Kushal Rajpar is saying, according to GST, anything other than goods will be termed as service. Yes, absolutely correct, that anything other than goods will be termed as service. So I am not on that point. What I'm saying is that if any packing which is incurred at the behest of the buyer, then there is no supply or no transaction happening between the supplier of the goods and the recipient. It is strictly a transaction between the supplier of the packing material and buyer. And the supplier of goods is only acting as a facilitator to the buyer of the goods to arrange that special packing material and supply his goods by packing in the special packing as demanded by the buyer. Now, when Mr. Anand is saying that it is difficult to accept the argument, I invite further views of the other participants about what do they believe. Yes, Mr. Anand is saying that it will lead to litigation. Yes, it may lead to litigation, but we are on the point of the jurisprudence and what should be the correct law. Now, there is another issue in this context of packing, that there may be a scenario where the packing is durable and returnable. So what should happen to such a durable and returnable packing? Whether the cost of such a packing, which is of durable and returnable in nature, whether it should be included in the value of the taxable supply. Now, again, I invite the the view of the participants about whether the value of the durable and returnable packing material Mr. Sanjeev Guski is saying in case of returnable not to include, then Mr. Khurana is saying returnable packing goes back to supplier and does not become part of the taxable supply. Mr. VS Jayakumar is saying he agrees with Mr. Khurana. Returnable packing will be considered as goods sent on approval basis. Since it is returnable, even in the case of charging tax at the time of supply, can be reversed on return by the buyer. Mr. Janardhan is saying returnable items are not required to be added as part of the taxable supply. Till there is no charge, the ultimate tax liability is zero. It is litigation from TNGST era to GST era. The packing is damaged, then it is not taxable. Returnable goods not forming part of the taxable value is what Mr. Prakash Moore says. Okay, let us now discuss some of the judgment in the earlier era on this particular issue. Honorable Supreme Court in one of this particular judgment, which is there in this slide, says that if there is an arrangement between the buyer and the SAC that the packing should be returned, then it is not the physical capability of the packing to be returned. Okay, another question in this context is that suppose I agree with the view of the most of the participants that if the packing is returnable and durable in nature, then it should not form part of the taxable value. Now, a consequential question is whether the packing is actually returned, whether it has to be seen. Suppose if the packing is returnable, but some of the buyers are not actually returning, then what happens in such a scenario? Whether in such a scenario it will become taxable at a subsequent date when it is known that the buyer has not returned. Mr. Mahendra Jain is saying that tax should be charged at the time of supply and deducted from supply at the time of return. Mr. Khurana is saying it will be taxable. Shivang Khandewal is saying supplier if charged to recipient then taxable. Yes, now let us have a look at the judgments. So one of the judgment says that obviously the cost of packing which is durable and returnable in nature has to be excluded, but it is not to be seen whether they are actually returned or not. Even if they are not returned, but if as per the terms of the contract, they are returnable, then it cannot be taxable. Now, in Tata Chemicals, I believe a wonderful ratio or the logic is also laid down. It says that why actual return is not material is because if the buyer is obliged to return the material to the supplier, then seller does not transfer the title in the packing material to the supplier. The seller retains the property in the packing material. So therefore, the question of levy of tax on such returnable material does not apply, and therefore, irrespective of the fact whether the actual return is made by the seller, by buyer or not, that need not be looked into and it will always be excluded. So this is the correct view. But I think Mr. Sivang Khandelwal has further given a view that if supplier charges to the recipient, then it becomes taxable. So correct. If suppose for non-returning the returnable packing, the supplier subsequently levies some amount of penalty or charge on the buyer, then such an amount will be taxable, but otherwise not. Now, in this very interesting tribunal judgment, which was subsequently approved or maintained by the Honorable Supreme Court, it was a Delhi tribunal judgment. Here, the distributor was incurring some, or the seller was incurring some advertisement cost. The manufacturer was somebody else. So the question arose whether the advertising cost incurred by the buyer in order to sell the product, whether it should form part or some part of that advertisement cost should form part of the manufacturer of the manufacturer also, manufacturer of the TV sets. So it was held that the TV manufacturer has no control whatsoever with respect to the advertisement. Advertisement being done by the distributor or the seller himself. And even if it leads to the benefit to the original manufacturer, such a advertisement cost cannot be said to be incurred at the behest of the manufacturer, and therefore it cannot form part of the assessable value. Now on discounts, there are a number of judgments. So in Honorable Supreme Court, very elaborately discussed the concept of the discount in Government of India versus MRF Limited. It's a 1995 judgment, and various types of discounts have been very elaborately discussed in this particular judgment. And it was said that the discount allowed in trade by whatever name such discount is described should be allowed to be deducted from sale price, having regard to the nature of goods. If established under agreements or under terms of sale or by established practice, the allowance and nature of discounts being known at or prior to the removal of goods, such discount should be allowed. Now, in this context, I ask a question, because there is another judgment of the Supreme Court also, that which is a very recent judgment, that giving benefit of a discount at a point of time subsequent to original sale purchase is a regular trade practice and qualifies for deduction. So there are a number of judgments which says that, in the context of obviously central excise, that if it is a established practice or it is in terms of the agreement or terms of the sale, then whatever may be the name of the discount, such discount should be allowed as a deduction. So now the question which arises in my mind is that what has been decided by the Honorable Supreme Court. Now in the GST Act, Section 15, subsection 3, clause B, Roman 1 says that value of supply not include any which is given after the supply has been affected, provided that the such discount is established in terms of an agreement entered into or at or before and the time of the supply. Now the question which arises in my mind is that, suppose there is no written agreement between the buyer and the seller, but there is a trade practice to give such a discount on an annual basis or a quarterly basis, then whether such unwritten agreement or such a trade practice discount which is subsequent to the sale, whether such a discount will be allowed as a deduction or not. Now, what is the view of you all? I would like to know. Mr. Sanjeev Guski says yes, if it is a normal trade practice. Mr. Kaushik Nahar says yes, will be allowed as contract can be oral also. Litigative, Mr. Sivang Khandelwal says litigative but can be sustained while verifying earlier trend. Yes, I agree. By and large, the opinions which have come out, I agree that now Mr. Khurana says in view of the specific provision in that only those discounts which become part of the original contract should be allowed as a discount. Yes, it is allowed. It is allowed. Yes, it is. Mr. Ganesh says it is debatable. Okay. My view is that what the law says is that a discount established in terms of an agreement entered into it or before any time of such supply. So my opinion is that suppose it is a established established trade practice, year after year such a discount is being allowed. It is being uniformly followed with respect to all the dealers or suppose customers. Then it should be allowed, because an agreement need not be in writing. By an established practice, one can say that it is an oral agreement, and therefore such an oral agreement binds everybody, and unless it is withdrawn in writing, that this sort of a discount will not be allowed any further. And if it is allowed, then in my opinion, it should be allowed. And that has been the opinion of the Honorable Supreme Court also, that if it is under a agreement or under terms of sale or established practice, then it should be allowed. And further, it is also not necessary that the discount should be in form of money. It can also be in form of the, suppose, additional quantity of the item being sold. in one of the judgment of the Honorable Supreme Court, it was said that a quantity discount a dealer received from the SSE is stated extra quantity if he buys certain other quantity. That this will happen is known and agreed at the time of transaction is entered into. It is therefore a trade discount and is allowable as a deduction. Further, one of the judgment of the tribunal says that the discount may be in form of the cash or in shape of the goods. Quantity discount has precisely the same effect as money discount, as in both the cases there is a reduction in price charged to the customers and hence permissible. Now, another question which I ask is whether warranty given in the name of a discount, whether it can be sustained. Suppose I give an example with respect to the tire industry, that suppose any tire is found to be defective, then depending upon the assessment of the defect, a discount is given. Say the subsequent tires are sold at a say 20%, 30% free of cost. And it can be said to be a warranty discount, because a tire is supposed to last for a particular period of time, and if it is within that warranty period, and if it appears on assessment of the engineer of the tire manufacturing company that the tires are defectively sold, then certain discount is given. So the question arises is that whether such a warranty discount given in the name of discount can be allowed as a deduction. I again invite opinion of the participants. So here the view of the Honorable Supreme Court is that such a warranty is not a discount, but it is in the nature of the benefit given to the customer by of a compensation for loss suffered by them in the previous transaction. So they are in fact a compensation nomenclatured as warranty discount, and therefore they should not be allowed as a discount. Now, there are discounts which are year-ending discount and prompt payment discount. So these are also discounts. It was disputed that they cannot be allowed since the quantification is not known at the time of removal, and the calculation are made subsequently. So at best, they can be said to be a bonus. So it was held by the Honorable Supreme Court that it does not matter that the quantum of discount is not known at the time of sale. It is enough if there is a practice which is adopted, and if that in terms of that practice, if the discount is given, then it will be allowed as a deduction. Now, in one of the tribunal judgments, discount given with respect to breakage in transit were allowed and allowed as a legitimate deduction. Now, another interesting issue which arises for discussion is notional interest on advance. Now, proviso to section 231, which defines consideration, says that a deposit, whether refundable or not, given in respect of supply of goods, shall not be considered as payment made for supply unless the supplier applies the deposit for consideration for supply. So advance, obviously we know that if the advance is received, then such an advance is liable for taxation. If a deposit is received, then deposit is not liable for GST unless it is adjusted for towards the supply. But my question is with respect to what happens to the notional interest, whether such a notional interest on either advance or deposit, whether they should form part of the taxable value. Now, I again invite the opinion or views of the participants about what do they think, whether the notional interest on deposit or advance received from the customer should form part of the taxable value. Mr. Sanjeev says not at all. Mr. Tarun Agrawal says not, no. Mr. Kaushik says no, it won't be included as it not consideration received. Notional interest do not form part of the taxable value. Otherwise, also interest on deposit is not taxable, is what Mr. Khurana says. R.K. Khurana. Then Mr. Ganesh says no, because entire value is to be taxable. Srinivas says interest is not taxable under GST. No, interest is taxable. Interest on late payment and all that is taxable. So why not interest on notional deposit of advance? Not to be added, Mr. Anand says. It is not realized and hence not taxable is what Mr. Sanjeev Goski says. Okay. So now let us have a look at the Supreme Court judgment. It was held that the mere fact of making an interest-free advance by a buyer to the manufacturer that by itself will not be a sufficient ground to reload the assessable value with notional interest. It would be necessary for the revenue to show that such an advance has influenced in lowering of the price and that it is not depicting the normal price of the goods. Obviously, where there are two prices, one for those who have made the advance and other for who have not, it would require no further proof of the lower price having been influenced by the interest-free advance made by the buyer. But otherwise, it would require proof, and the proof for the purpose of holding that the interest-free advance has influenced the price provided by the revenue. No presumption can be drawn by mere fact of the interest-free advance by the buyer to the manufacturer. So I think the Honorable Supreme Court has laid down the very wonderful principle of law. So the answer is both yes and no. If such an advance influences the price, then price does not remain the sole consideration. It becomes influenced by such a notional advance, such an advance, and therefore we need to apply the valuation rule. And probably, even if the notional interest is not added to the taxable value, even then we have to discard the transaction value and take a recourse to the valuation rules in order to determine the taxable value. Because it can be said that such an advance has influenced the price. But obviously, if the price is available, the normal price is available, which is at which the product is being sold to an independent buyer, where the price is not influenced by the advance, then as we go and discuss the valuation rule, we'll see that such a price can be adopted for the purpose of determination of the taxable value. Now, the other issue is what are the circumstances or what is the rule of valuation when the price is not consideration, sole consideration for supply, because when the consideration is not solely in money, so then how the valuation rules comes into the picture. So the valuation rule says that if the sole consideration for supply is not solely in money, then the taxable value has to be determined in terms of the rules, whereby you apply the rules sequentially. First priority is that it should be the open market value of such supply. Now, the open market value means that the price of that product in money payable by a person in a transaction where the supplier and the recipient are not related, and price is the sole consideration. So suppose there is a transaction where price is not consideration and there is a barter, then you go and find out that where if there is a transaction where there is such a barter transaction is not there, and such value shall be adopted where the price is not the sole consideration. For example, suppose you go and buy a television set. We all know that in many cases or most of the cases, such electronic products, they accept your old television or old refrigerator and give some discount towards that. So if the price is say 40,000 and say 4,000 discount is given, then 40,000 is the normal price and GST will have to be paid on the 40,000 and not the 36,000, which is actually recovered from you. But if suppose there's such open market value is not available, then you find out the total money value of the supply, that is money consideration plus money value of the non-monetary consideration. Now, if this also fails, this is also not available, then value of supply of the like, kind and quality is what has to be adopted. And if this is also not available, then the value of supply has to be made on the basis of the cost. That is the cost of supply plus 10% markup. And lastly, if all these methods fail, then you go to the ultimate residuary rule, which is that you apply or you determine the value on the basis of any reasonable means. So, in order to determine the price, the comparable price, the wholesale price and retail price cannot be compared. So there is a judgment in the context of earlier era that the selling price of 100 kg of goods and to an unlimited buyer cannot be adopted for comparison of sale price of 10,000 kg of similar goods. So you have to look into the magnitude of the transaction also. Further, the method of valuation of the like, kind and quantity, there is a judgment of the Honorable Hyderabad Tribunal which says that you have to look into the time factor also, that they are almost at the same time or around the same time. Now, in one of the Supreme Court judgment, it was held that giving quantity discount for higher quantity is not unusual, and therefore it cannot be said that merely because of such a discount there is any undervaluation. So this is also very important to know, that just because you are giving more discount to a particular customer who is your high value customer, it cannot be said that the price is not consideration for sale or you are related in any manner, and this transaction value cannot be adopted, and the department can make an allegation of undervaluation. Now, in another judgment of the Honorable Supreme Court, that it was pointed out that mere existence of agreement between the manufacturer and the wholesaler under supplement obligation would not render the price any less than the wholesale price. In another judgment of the Bombay High Court, it was says that the merely because the buyer undertakes to carry out the after sales service during the buyer period, warranty period, this by itself would not make him a related person. Now, let us look at the valuation rule. If the buyer and seller are related parties. So if that be the scenario, then the rule which is applicable in the case the price is not the consideration of sale, that rule itself applies, except the option 2, where you adopt the value of the money of the value, you add the value of the money to the monetary value of the non-monetary consideration. Other than that, the valuation rule is the same. So if the buyer and seller are related, further it says that if the recipient is eligible for full tax credit, then the invoice will be deemed to be the open market value. Now this is very important, because it so happens, and it will happen, that suppose in the context of GST, we know that in terms of section 25, if you have, say, unit all across the country or establishments all across the country, then if there is a transaction between, say, a manufacturing unit in West Bengal with a manufacturing unit in, say, Tamil Nadu, you are making a stock transfer, then they will be treated as a separate establishment, and you will have to, of course, charge GST. Now, whatever you charge a GST here, that will be available as input tax credit in your buyer unit. Now, suppose you don't apply the valuation rule and you adopt any value for the purpose of such transaction which suits you. Then the question is whether the undervaluation allegation can be made against you. So in order to counter this scenario, a proviso is there in the rule itself that if the input tax credit is admissible, then the invoice value, whatever you declare, will be deemed to be the open market value. Now, this particular principle, fortunately, the government has adopted from the jurisprudence in the erstwhile era, wherein it has been consistently held that the undervaluation allegation should not be considered when there is a transaction between the related parties and the one of the unit is eligible for input tax credit, because it is a revenue neutral exercise, and the SEC does not gain anything by paying less tax, because ultimately it is available as credit to his sister concern. So this principle now form part of the valuation rule itself. Now, on the with respect to the related parties, there are some interesting judgments which says that merely because two parties are related to each other, it will not amount to undervaluation per se. It will depend on the facts or circumstances of each case. So the Supreme Court says that just because the parties are related, you should not discard the transaction value unless you have a reason to believe that there is a suppression of the price. Now, similar judgment has been rendered by various tribunals that if the relationship has not affected the price, then that price should be adopted and transaction value should be accepted. So there are some judgments which I have referred to here. if wherein it has been held that just because there is a related party relationship, it does not mean that there is a undervaluation unless it is available from the record. Now, let us look at a very important concept which has often led to a lot of dispute, is the concept of pure agent. Pure agent is whereas an expenditure or cost is incurred by the supplier as a pure agent of the recipient, then it has to be excluded from the value of the taxable supply. So the idea is that the pure agent should not be using the goods for his or services for his own interest, for the purpose of provision of its, for the purpose of undertaking the transaction of its supply. And if it is done so, then there are 4 conditions which emerges from the definition of pure agent, that they enters into a contractual agreement to incur expenditure or cost, and the supplier does not holds or intend to hold the title in the goods or service which is supplied as a pure agent, does not use it for his interest, and receives only the actual amount incurred to procure such goods or service. So here in this context, there are number of judgments which says that suppose a stockbroker incurred some transaction charges and recovered it from the clients and remitted the same to the stock exchange, then it cannot be said to form part of the taxable value. Then clearing and forwarding agent, if is incurring expenses like loading expense, go down, rent, freight, electricity, labor, etc., then they are said to be incurring those expenses as a pure agent and should not be included in their taxable value. Then so there are various scenarios in which you see if the expenditure is incurred on behalf of the agent, then it will not be included. Now I ask last question, that suppose what happens to reimbursement of expenses, where suppose a chartered accountant goes to undertake a audit and he incurs suppose hotel expenses or traveling expenses, then whether the GST can be is payable or not, or whether it can be said to be an expenditure incurred as a pure agent. Yes, it depends on the engagement letter whose responsibility it is to bear. It will not be considered as a pure agent contract. It is part of a CA service and reimbursement is fully taxable. GST is leviable. Yes, in my opinion, it should not be considered as a pure agent, because one of the condition for being a pure agent that the supplier does not hold the title of the goods or service. Here the expenditure is incurred in his name. So therefore, such an expense should not be excluded. Now with this, I conclude my today's discussion. Now I will be taking some of the questions which has already been raised. You may raise further questions also. Now, Mr. Ajay Kumar Agarwal is asking if special packing is made on request of the buyer. Now, participants, you are requested to raise your queries in the question and answer box. It will be easier for me to track it. So previously also, if you have asked any question and it is lying in the chat box, then it will be difficult for me to retrieve. So I request you to copy paste it in the question answer box. So it will be easier for me to answer. Now, Mr. Ajay Kumar Agarwal has asked if special making is made on request of the buyer, can he claim ITC? Now, Mr. Ajay, as I said that if special making is made on request of the buyer and if it does not form part of the transaction value, then the question of taking ITC on it should not arise at all. Because he is not holding the property in that packing material for himself. Merely at the behest of the buyer, he is taking the reimbursement. The entire expenditure is incurred as a pure agent. He does not hold the title of such packing material, and therefore that question should not arise. But my view is that if suppose the special packing is also made at the request of the buyer, but it is purchased by the supplier in his name, he is holding the title, then ideally, in order to avoid any litigation, he should claim the ITC and he should also discharge the GST on that. You see, my discussion is purely on a legal angle that in my opinion, the special packing, if it is at the request of the buyer, then he does not hold the title and it has no connection or it is not incidental to the supply. So that is the reason I believe that it should not be taxable. But if one wants to avoid any litigation and such a packing is also purchased by him and included in his books of accounts and subsequently claimed as a reimbursement, then it is better that one claims the ITC and also discharges the GST. Now, Mr. Kaushik Nair had asked, a person manufactured goods, packing material provided by the merchant exporter, whether goods can be purchased from manufacturer at the rate of 10% under this circumstance. I could not understand or could not make out anything of what you are trying to say. If you can retype your query, I will try to answer. Mr. Daga is asking, I am charging 150 paise number to buyer unrelated and buyer related rupees 15. No, if you are obviously charging only rupees 15 from the related buyer and 150 rupees to the unrelated buyer, then you'll have to pay GST on 150 rupees as per the valuation rule. Mr. Bad is asking, what about electricity charges recovered by mall owners from shop along with the maintenance charges? I'm giving my email ID here. I will keep answering the questions, but I'm just giving my email ID. So if you have any further queries also, you may mail it to me. I will certainly answer them. What about the electricity charges recovered by mall owners from shops along with maintenance charges? I believe that electricity charges are strictly incurred by the mall owner on behalf of the buyers, and they can be said to be satisfying the definition of the pure agent, and they should not form part of the taxable value. But as far as the maintenance charge is concerned, GST will have to be paid on maintenance charges. If car is transferred between distinct person, one state to another, at what value it should be transferred? the car is transferred between distinct person. How does it matter whether it is between one estate to another? I mean, the value, whatever be the transaction value, the GST will have to be paid on that. TK Chandrasekharan is asking, is reimbursement of expense to be excluded from taxable supply? No, reimbursement of expense cannot be excluded unless it is in the nature of a pure agent. Whether extra work for sale in real estate project is separate service and chargeable at normal rate, or is it part of the construction of the complex service? Mr. Piyush Panchal is asking, I believe that if any extra work in a real estate project is done, then it is incidental. It should be treated as a composite supply, and your main supply is the construction service, and whatever incidental extra work you are doing should be taxable at the rate at which your main supply is being done as per the definition of the composite supply. Because if any incidental work is done, then the definition of composite supply says that it should be treated as the main supply or the principal supply. Mr. Choksi is asking, Sanjeev Goski, some FOC parts given by customer to add in finished product. Responsibility is on customer only. Then that parts value need to add in the finished value. Title of FOC parts is of customer only. Certainly not. If the FOC parts is given by the customer to add in the finished product, which is not the liability or responsibility of the supplier, then it need not be added in the finished value, finished goods value. Mr. Sivang Khandewal is asking regarding ITC of sale promotion expenditure by pharma industries. Please clarify whether ITC be claimed on the sales promotion items purchased and supplied at the sales promotion. In my opinion, ITC is certainly available. Sanjeev Goski, can distinct persons sell between them at any price if credit allowed and if not allowed also? Distinct person can sell at any price provided credit is allowed. But if the credit is not allowed, then you follow the valuation. Mr. Piyush Panchal is asking, in case of sale of residential unit, first agreement rupees 50 lakhs with land. Thereafter, one more agreement for extra work. Then what rate should be applicable? I have already answered this, that that it should be treated as a composite supply, and for extra work also the same the tax should be discharged at the same rate at which the sale of residential unit has taken place. It should be treated as a sale of residential unit only. Mr. Rajesh Vaid is asking, the division bench of Calcutta High Court has confirmed the LBW case which was argued. Do you appear in this case, or can you throw some light on it? Yes, I appeared in the division bench also. So the division bench has dismissed the appeal of the department, whereby you see the ITC was sought to be denied only on the ground of the cancellation of the registration of the supplier. So the division bench has said that you examine the documents. If the documents are in order, then the ITC cannot be denied. Then Mr. Daga is asking, why construction contractors taking GST registration in different states? Can they do interstate service? You see, the contractor, as per the place of supply provision, wherever they are working, they are supposed to take the registration. So that is why they are taking separate registration. Then Mr. Tarun Agarwal is asking, pure agent was brought from ST regime, but in GST it continues to applicable to suppliers of service and not to supplier of goods. How is it rational? Academic question. Yes, you are very correct. I mean, I agree with you that I think if any goods is also supplied as a pure agent, then the concept of then it should not be taxable. But I believe we can draw ratio from the section 15 itself, which says that whatever is incidental, it can only be charged to tax. So it has to be incidental to the main supply. So if something is supplied, but it is not incidental to the main supply, and it is only and the supplier is only acting as a facilitator and not as a supplier of that goods or service, then the question of taxability in the hand of that a person should not arise. And I discussed that in the context of packing material also. In case of labor contractor, GST to be paid on reverse service charge or total payment including labor salary. In case of a labor contractor, service tax GST has to be paid on the total payment including labor salary, because the laborers engaged by the contractor, labor contractor, cannot be said to be a pure agent expense. Then Mr. Sivang is asking, work contractor received advance of rupees 4 crore and GST TDS has been deducted by the recipient of service. Later on, the said advance returned by the contractor due to disputes between them. Is there any hit on the GST TDS in the hand of works contractor? Under the fact that the work contractor had already filed GST TDS credit, already came in his GST ledger and even utilized by him. Then Mr. Khurana is asking, the excluding part of section 15 does not make any distinction between interest, whether there should be some part of. Yes, I totally agree with Mr. Khurana that it is immaterial whether interest is paid as part of the contract or whether it is in terms of any law. Thank you, participants, for your wonderful participation and taking interest in the today's session. With this, I close today's session. Thank you very much.
Hello, sir.
Yes.
Shall we wind up the session for now?
Yeah, I mean, I will mail you the PPT.
Yes.
So kindly forward it to all the participants.
Yeah, sir. We will share the recordings and the PPT tomorrow itself.
Yes, yes. Thank you very much.
Yeah. Thank you so much, sir, for the wonderful session.
Thank you. Thank you.
Yeah. So is there any date for the next session?
The next session we should do on 22nd.
Yeah. Yeah.
22nd of January.
22nd of January. Yeah.
Shall we do it on any Saturday? Will it improve any part of the further participation? What do you say?
Yes, yes.
I think next session, let us try on a Saturday.
Yeah, that would be perfect.
Because I think the Sunday people are, I think, little bit lazy.
Yes, yes.
So let us do it, or let us try it on the 21st. Next session.
Yeah, sure, sir.
Okay, so please, I mean, forward that. I mean, intimate to the participants in advance.
Yeah.
So that I mean, so the time we will keep the same 11 to 1.
Okay.
11 to 1 on a Saturday, 21st.
So there are some suggestions in the chat box from Mahesh Kumar, Sunday evening. They want it.
This Saturday evening they are saying.
Yes, yeah, Saturday evening.
Mr. Sushant Kumar Saha is saying Sunday will be better. So I think let us try one session on a Saturday.
Yeah,
Then we'll see how it goes.
yeah, sure, sir. We can schedule it on 21st of January.
Yeah, 21st of January.
Yes.
Okay, thank you.
Yeah, thank you so much, sir. Thank you all the participants.
Thank
We can wind up the session.
Thank you.